Good morning, welcome. You're watching Market Cafe on ET Now. I am Harsh Saita and with me is Ankita Saxena. So Ankita, global markets, even through this week, have been on quite dizzy.
Absolutely, especially after the Bank of Japan move yesterday. What a whammy.
Absolutely. So talk to us about all that's happening in global
Absolutely, Harsh. Thank you so much. Very good morning to all of you. Now, Bank of Japan caught the markets completely off guard by tweaking its yield curve control policy to allow the yield on the 10-year Japanese government bond to move 50 basis points up from 25 basis points which was there previously. Now, either side of its 0% target. Now, the move, as you know, the BOJ said, was intended to improve market functioning and encourage a smoother formation of the entire yield curve. Now, however, this move was, rather shook off by the US markets that sent the global yields up. US market was rather muted on this announcement. The Dow Jones Industrial Average rose 92 points or was up more than 0.25%. The S&P 500 gained 0.1% in trade yesterday, and Nasdaq Composite ticked up just 1 point in trade. So a rather muted response to the Bank of Japan's decision. The European markets, however, closed lower after the surprise move by Japan. The Pan-European Stock 600 closed 0.4% lower after a very choppy afternoon session. CSE and DAX were down almost 0.5% in trade yesterday. So that was the roundup of the US and the European markets after the announcement from Bank of Japan. Over to you, Harsh. How is the Asia market faring right now?
Well, yes, Ankita, we're seeing the Asian markets also largely taking a cue from global markets. But prior to that, let's talk a bit about oil. Oil has in fact paired some of those gains. Oil has been in a very tight range. We're looking at anything on the Brent at least between 78 and 80 plus. But at the moment, it's paired some of those gains. In fact, Brent is at the $80 mark versus yesterday when it had gained a little bit. And it had gained largely on the back of a softer dollar, as well as the US plan to restock its petroleum reserves. Mind you, those elections had led to some tapering of those petroleum reserves, but this will really add on to those petroleum reserves, which will put a little bit of pressure on oil prices. That's the anticipation. But China, again, the increase in COVID cases is keeping oil largely flat. So oil has come slightly off, or rather pretty much flat, as you can see, 4 basis points higher. But that's where oil currently is. It's in a tight range. And that's where we are at, where oil is concerned. Where gold is concerned, gold has spiked. We've seen a good, nice spike in gold. It's up around 1.5+%. In fact, it's breached that $1,800 an ounce mark. And that's largely, again, on the back of the BOJ move. The BOJ move has sent not only interest rates higher, it's also sent commodities slightly higher, and gold and silver, you can see the impact on that of the BOJ move.
Right, so that was a roundup of the global markets and the Asia market for you. Now, there are a couple of events to watch out for in today's trading session. Now, first up is the fact that today is the last day to subscribe to FinTech Technologies IPO, so do keep an eye out on that. Also, a couple of board meetings lined up. First up is MTAR Technologies. Board meet will be considering the small satellite launch vehicle project and noting of the MOU between MTAR and InSpaces. Now, specialty restaurants will be having a board meeting also to consider and evaluate proposals for raising of funds. And in corporate action, we see Keystone Realtors lock-in period will open today. And Just Dial, promoter Reliance Retail Ventures intends to complete the sale of shares within a period of 8 trading days beginning today, which is 21st of December. So these are the events that you need to watch out for today.
Thanks for that, Ankita. Clearly seeing some of those companies is what we will keep our eyes out on today. But Bill Gross said he expects big trouble ahead should the Federal Reserve keep hiking interest rates. He also said that there is potential chaos in financial markets. The investor also said tightening of monetary policy would further roil capital markets. he sees potential defaults for commercial real estate as well.
And OPEC and its allies have no choice but to remain proactive and preemptive given the uncertainties that face the market, according to Saudi oil minister. He highlighted that the market has been subject to some extreme shocks. He also said that the proactive approach and the preemptive steps that OPEC Plus adopted has helped avoid havoc in oil markets.
Well, focus continues to be on Elon Musk. Elon Musk may have been serious while pushing the poll on Twitter, where he asked if he should step down from the role of CEO. Reports suggest the billionaire is looking for a new chief executive for the company. Remember, he had said in court in November that he expects to reduce his time at the company and find somebody else to run Twitter over time.
And the US is sending the equivalent of one cargo every day to Europe so far this month. This is the fastest rate since June 2018. The diesel export rates have quadrupled, according to the data from Kepler. Strong flows underline European efforts to stock up before EU ban on Russian fuel kicks in on the 5th of February.
Well, and the White House and congressional security officials were laying the groundwork for a possible visit from Ukrainian President Volodymyr Zelensky. The Ukrainian president could address lawmakers during a joint session of Congress in the House chamber and is poised to approve a new spending bill, the Congress is, and that includes around $45 billion in aid for Ukraine.
And Apple will begin producing some of its MacBook computers in Vietnam in 2023, according to a Nikkei Asia report. The move reflects the tech giant's push to expand its manufacturing beyond China. Apple is grappling with increased US-China trade tensions and supply chain disruptions related to COVID lockdowns.
And well, Nike reported quarterly results that easily topped Wall Street's expectations. The company also raised its outlook. This is against the backdrop of the company touting its success in clearing through its hefty inventory pile. Shares of Nike rose more than 10%, of course aiding indices.
And the Indian government has some ambitious plans to make India a $5 trillion economy by FY25. Now, while this needs all the industries to fire on all cylinders, it is the emergence of the gig economy that is giving a big thrust to government's plan while encouraging inclusivity. But what role will gig economy play in India's development? Stacey Pereira answers all these questions for you. Listen in.
The gig economy is often used as a wide range of activities to do, not including permanent employment. Now, in recent times, it is the rise of food delivery as well as e-commerce platforms that has created the most jobs in the gig economy. So why are gig workers that important to the economy? Well, a report by the Boston Consulting Group indicates that the participation of gig workers is higher in developing economies, where the majority of the workers are employed in deliveries, ride sharing as well as micro tasks. But another report suggests that blue-collar gig work provides employment to low-skilled workers who are the sole breadwinners of their families. Now, the importance of gig work grew during the pandemic when several blue-collared workers enrolled for food delivery services to provide a source of income to their families. Now, the gig economy is also expected to grow from an employee base of 8 million currently in 2023 to about 200 million by 2029. But most of these employees are expected to migrate from the unorganized sector, and this one is one of the biggest roles the gig economy can play. Now, it can bring that unorganized workers to the mainstream and make the economy more inclusive for the socially as well as economically weaker section. It also provides more aspirational workers to the opportunity to become micro-entrepreneurs. Now, while India needs all sectors of the economy to fire on all cylinders to achieve that $5 trillion goal, it is the gig economy which can lead the way to bring socially weaker sections into the mainstream. And that's why we're really pinning our hopes on them.
Well, thanks for that perspective, Stacey. With that, we'll slip into a very short break. Don't go away. Of course, more on the other side, on the domestic side. Hi, good morning. Welcome back. You're watching Market Cafe with Ankita and me on ET Now. Now, SEBI had its meeting yesterday, and SEBI has accepted the Keki Mistry Committee proposals towards gradually phasing out open market share buybacks. The regulatory body has raised the minimum utilization of the amount for buyback via stock exchanges to 75% versus the earlier 50%. It will also create a separate window on stock exchanges for share buybacks. Listen in to what the SEBI chairman had to say.
In the interim, since we don't want to have any knee-jerk reaction to anything and we have given a glide path, we propose that there will be that minimum utilization of the earmarked amount should be increased from 50% to 75%, which means that if you announce a buyback, you must at least do 75% buyback. And also that there will be a separate window on the stock exchange. It cannot be nebulous and it matches with just anybody. There is a separate window for buyback. And that will also assist going forward in terms of identifying the tax-related issues, which are important in the whole buyback mechanism. So removing altogether the requirement of filing and observations, which saves time, and also cutting short the tendering period and the period requirement for payment.
Well, that was the SEBI chairman on a SEBI announcement on the buybacks. My colleague Ankur Mishra also filed this report earlier on this meet's outcome. Let's take a look.
Yes, the SEBI board has taken important decisions. One of them is the amendment to buyback regulations, and SEBI has made quite clear that they are not in favor of stock exchange route for the buyback, and that will be phased out in a gradual manner. In fact, the glide path is that from 2023 it will start, and by 2025 there will be only tender route for buybacks, and that is what SEBI has envisaged. Apart from that, a decision has also been taken for execution only platform, and that will be there for the direct plans for mutual fund schemes. One of the concerns of the investors has been during the disruptions in trading hours due to the fault of the broker when there is a technical glitch or so, and for that now SEBI has decided to set up an investor risk reduction access platform. This will be a platform which will be active after there is a problem, a technical problem at the broker, and the investors will be able to square off their orders. However, SEBI has made clear no new orders will be placed on this platform, and this platform will be active by Q3 of 2024, meaning the next financial year. Apart from that, SEBI has also decided to come up with the qualified stock brokers list, and now in that list the all important brokers will be there who are systematically very important, and due to that there can be a risk of, or if at all they fail. So that list will be prepared by SEBI, and there has been an amendment in the SEBI Act for that. And as far as the current scenario is concerned, we did ask SEBI chairperson how many brokers may come in the list, and overall 16 brokers may be part of this list as if it is taken or designed in the current form.
Well, thanks so much for that, Ankur. Meanwhile, RBI in its bulletin has flagged darkening global outlook. That's the warning for emerging market economies that they appear to be flagging off. Now, they are talking about those economies which appear to be more vulnerable, but Governor Das also adds that the Indian economy remains resilient, drawing strength from its macroeconomic fundamentals. We caught up with experts to analyze the fine print on this one. Listen in.
I do completely agree with that. And to appreciate that particular view, we possibly would have to take a step back and see the broader fundamentals of the characteristics of the economy. And if you try to see that, you will find that India, I'll not call it decoupled, but at the same time, India's linkage or dependence on the global economy is relatively less compared to some of its peers. Number two is, another way of telling it is the global, the domestic economy is pretty large, And there are multiple drivers, not one driver. It's not consumption only, it's not investment only, it's not export only, or rather some kind of a balanced, large, less balanced economy, large economy, and less dependence on global economy possibly gives India some kind of a buffer that is not really present today with a lot of countries. Also, I think one particular factor remains very critical going ahead in the near term over the course of the next possibly 3 months, the rising discussion or the rising cases of COVID again in certain parts of the globe, particularly in case of China. I think how exactly that plays out, that will have a lot of bearing on the region, including on India.
Right, and we have my colleague Ankur Mishra joining us again on this for further details. Let's take a look.
Yes, RBI's bulletin talks about the risk which emerging markets are facing currently. The balance of risk is increasingly tilted towards a darkening global outlook, and emerging markets are more vulnerable to these kind of risks. The RBI bulletin has mentioned the near-term growth outlook for Indian economy looks robust as per RBI's bulletin. And remember, even Reserve Bank of India governor had indicated that the Indian economy remains resilient. And however, the growth target was moderated from earlier target of 7% to 6.8% for the current financial year. But it was also mentioned that even domestic factors are concerned, the inflation remains within the range which has been projected by Reserve Bank of India, and that remains 6.7% in the RBI's bulletin. It has been mentioned that the global inflation may have peaked out. Now that is something which even RBI governor had mentioned that as far as the current inflation is concerned, although risk remains, but it remains that the peak of inflation has happened, and the moderation of inflation may happen by the next financial year. Now, as far as the Indian economy is concerned, the buoyant corporate sales and turn up in investment in fixed assets are heralding, and it is beginning to show that on domestic front, the Indian economy remains resilient.
Thanks again for that, Ankur. And shifting focus to the steel industry, the government has put in place a national green steel policy for reducing India's carbon emissions. Speaking at an event, Steel Minister Jyotiraditya Scindia shares the government's aim to increase steel production to 300 million tons per year. He also emphasized on the need for more eco-friendly approach to steel production. Listen to what he had to say.
Steel is the primary ingredient that takes an economy forward. And we've progressed a lot in the last 8 years. From a production capability of close to 100 million tons per annum, we are today at 150 million tons per annum. And our target is by 2030 to double our current capacity of 154 million tons per annum to 300 million tons per annum. As we have become and donned the mantle of the second largest producer of steel in the world, that we also become a responsible producer of steel in the world. And therefore, the government has put in place a national green steel policy, because that is where the world is headed in any case.
Moving on from steel to FMCG, what's in store for FMCG companies in 2023? My colleague Aishwarya Patil caught up with Nestle India's Suresh Narayanan on the sidelines of a CII event. He shares how customers want to travel and explore, which is leading them towards a more premium products. Listen in to what he had to say.
Organizations' value chains are not built on 1 month's pricing. So it will be over a period of time. I think one is seeing some amount of moderation coming in, but yet there are some commodities where the prices continue to be fairly bullish. Whatever happens on the value and pricing front will be a result of the balancing between all the commodities that go to make our mix. And at the moment, I think it's too early to prognosticate whether it will be better, substantially better, or equal to what was the impact in 2022.
So what kind of consumer trends would you say observed in 2022, and what's your goal for what Nestle's goal for 2023?
I think consumers are clearly operating in 3 or 4 spaces. Firstly, the value space is still very high. People are looking at value for money, but people are also going in for premium brands. There is a premiumization effect that is taking place in the economy as a result of greater exposure, greater travel, greater aspiration, and also in some strata of society, better incomes.
Well, always great perspective, getting views from Nestle itself. But quickly moving on, we're going to try and get you what we're going to take in the market today, which is at 9:20. We're going to have Pankaj Tibrewal, who's the Senior VP and Fund Manager Equity at Kotak Mutual Fund. That's going to be on his outlook for 2023. Very interesting conversation there with him. At 9:35, we have Kulin Lalbhai, who's the Director at Arvind Fashions. That's largely on the growth strategy for Arvind Fashions, the growth trajectory and the outlook going forward. And of course, then we have Anshu Malik, who's the CEO and MD at Adani Wilmar. And that is largely on the best performing IPO that Adani Wilmar has been of 2022. But welcome back. You're watching Market Cafe with us on ET Now. Now, quickly moving to how Asian markets are looking in early trade. We did see US markets see a slight bounce, and Asian markets are largely seeing that as well. We're seeing the Nikkei absolutely flat, of course, on the back of that Bank of Japan announcement. That's largely along expected lines. But when I quickly move on to the other Asian indices, we're seeing the Hang Seng as well as the Shanghai gain. Again, the Shanghai largely flat, but the Hang Seng is up around 0.25%. Again, China is largely under pressure on the back of those rising COVID cases. The Kospi is up around 0.25%, as you can see on your screen. And we also have the ASX 200, which is up a good 1.3% as we speak. So we're seeing green largely across the board or flat. So we're not seeing any, much of negative at the moment from some of these indices. And it's a funny day because we are also seeing that bond yields have gone up. We're seeing the US 10-year bond yield above that 3.7% mark. So a solid 20 bp rise even there. And despite that, global markets across have also gone higher. So that's definitely something unique. The other piece is even the US futures continue to be in the green. So there's positivity there as well, and that's trickling down on the SGX Nifty as well. We're seeing 1/3% higher on the SGX Nifty at the moment, almost 70 points higher as we speak. We did talk about oil and gold, so we won't delve into that, but oil is largely range bound. To sum it up, that's where we're currently looking at oil. $80 a barrel is where Brent is currently at. Gold has seen a slight spike towards that $1,827 a barrel, 1.7% higher on that BOG announcement. And silver, you can see, has flown away 5% higher as we speak. We're also seeing gains on Bitcoin. Just below that 17,000 mark is where Bitcoin is, and across cryptos we're seeing a bit of a recovery, but nothing meaningful at the moment. But that's where we're at currently.
Well, right, that was the Asia market check for you. Now, we have Ashesha and Lisa in the studio. First up, Ashesha, tell us what are the trades what are the stocks we should be watching out for in today's trade for the Indian markets before the Indian markets open up?
Absolutely. Good morning, Ankita. So first up, we will have Sterling and Wilson in focus in today's trading session. It will be in focus for second consecutive day, and that is because promoters are intending to sell about 3.57% stake via OFS. This OFS was open for non-retail shareholders yesterday, and for retail shareholders.
So we're looking at some logistical issue on Ashesha's side, but we'll quickly go to Lisa actually. Lisa, talk to us about Kalyan Jewellers. What's happening there?
Yes, well, Kalyan Jewellers, they have updated at its Nuvama management meet that franchising will be a key driver for the future store additions. Also, they'll be focusing on improving the ROCE by increasing the franchise store mix and also divesting its non-core assets. So the non-core assets they'll be shedding, it will be worth around 600 to 700 crore. Also, they'll be stepping up the store additions and they're targeting 52 stores in calendar year 2023. The new cocoa stores are already delivering strong ROCEs with in the range of 25 to 26%, and that is driven by operating leverage. My Kalyan network is also integral for its customer acquisition. So Kalyan Jewellers sounded quite upbeat on its business, and it aspires to be a pan-India player after Tanishq. So that's the update coming from Kalyan Jewellers. Over to you.
Well, thank you so much for the details, Lisa. Now, let's quickly move on to my colleague Vamakshi, who's here with the brokerages this morning. Vamakshi, tell us, what are the brokerages saying?
Well, absolutely. Good morning to all of you all back in the studio. Let's first start off with L&T. We have a note coming from JP Morgan, and they believe that non-core businesses the divestment is on track. Assets have a negligible contribution to L&T P&L, and the key driver though is the pending sale of the Hyderabad Metro. So on the back of that, we have JP Morgan maintaining an outperform rating on L&T. They've given a target price of 2,200 per share. Lastly, we will be focusing on Samvardhana Motherson. We have a note coming from Motilal Oswal, and in fact this counter is Motilal Oswal's top pick for 2023. They believe that the worst is behind and operating performance should only start recovering here on. They also believe that the company is well placed to benefit from easing supply side issues. Demand continues to be strong, resulting in expansion in their order backlog. They are expecting strong financial recovery as well, led by normalization in production. So on the back of that, we have Motilal Oswal maintaining a buy rating on Samvardhana Motherson and target price of 95 per share, which actually implies an upside potential of nearly 37% from the current market price.
Well, thanks, Vamakshi, for all of that. Of course, missing you in the studio today. But we'll quickly move on back to Lisa. We have Sirma SGS in its management meet said that capacity addition, which is on track to meet emerging market demand. It also expects to beat industry growth in FY23. Lisa, of course, is going to take us through all of those updates. Lisa.
Yes. So to meet the expected EMS demand boom, Sirma SGS management, they updated that the capacity addition is on track and a total of 5 SMT lines will be added by the end of FY23. Management updated that they are seeing strong demand traction from the auto vertical amidst the EV boom, and management is also seeing high margin opportunities in both the industrial as well as the healthcare segments. They expect to be the industry growth in FY23 with operating margins in early double digits. However, on competition, they sounded slightly cautious as that is likely to emerge, but pricing pressure is unlikely in the near term. Back to you.
Well, moving on quickly to Ashesha is back with us in the studio to tell us what the trade setup is going to look like today. What are the stocks that you need to focus on in today's trade?
Yes, so Sterling and Wilson will continue to be in focus for second consecutive day. Remember, promoters are intending to sell about 3.57% stake in the company via offer for sale. It was open for non-retail shareholders yesterday, and for retail shareholders it will be open today. So on account of that, keep an eye out on Sterling and Wilson. Moving on to Dabur India, in focus on the back of the big block deal that took place yesterday, where Burman family in the block deal sold about 1% stake in the company. They've gone ahead and informed the exchanges that the purpose of doing this transaction is to raise funds for financing some private ventures in the private hands of the Burman family. Keystone Realtors will also be in focus because anchor lock-in ends today. About 1.5% equity will be out of lock-in, which means these shareholders will now be able to sell their shares freely in the open market. Moving on to Jubilant FoodWorks then, that will also be in focus. And why is that? Domino's has launched 20-minute delivery across 20 zones in India to deliver hotter, fresher and tastier pizzas across those 20 categories. Just Dial will also continue to be in focus for second consecutive day, and that is because promoter Reliance Retail Ventures, which intended to sell about 16 lakh shares to meet minimum shareholding requirements of SEBI, promoter will start selling these shares for 8 trading days beginning today, which is the 21st of December. KPI Energy will also be in focus, and that is because Board of Directors will be meeting on the 5th of January to consider stock split. Lastly, Specialty Restaurants will also be in focus, and that is because Board meet to consider and evaluate proposals for raising of funds is scheduled to happen today. So on account of that, keep an eye out on Specialty Restaurants as well. Back to you.
Well, thanks for that, Ashesha. We'll keep an eye out on all of those stocks. Quickly moving on, City Union Bank will be in focus, and I'll take that up. In fact, RBI has flagged a divergence in its GNPA by 259 crore. Now, what does this mean essentially? This is fairly normal for the RBI to conduct these reviews. But what is not normal is to report a large divergence larger than 15%. And as and when the divergence exceeds 15% of what the company has already provided for, the RBI or rather requires the company to disclose that to exchanges, and that's exactly what's happened in the case of City Union. So they've had to disclose that 259 crore divergence. What this means within the 259 crore is that 75 crore has already been provided. So they have to now provide for 185 crore. How substantial is this chunk? Well, City Union has made a profit after tax of roughly 250 crore in the last quarter, which means that this will largely erode 1 quarter of profit for City Union. But what's not okay and what may be a bit of a red flag is that the processes clearly don't seem to align with the RBI's procedures and processes of quantifying the amount of GNPA, which may be a bit of a red flag. In the past, we've seen instances like Yes Bank in 2016, 17 and 18 also being flagged off by the RBI, and Axis Bank also having to report a similar issue in 2017, which led to a larger cleanup within some of these banks and a drag in some of these banks. So keep an eye out. City Union Bank will be something that will be buzzing today.
Well, moving on to the movie buzz, while Avatar 2 might have failed to impress the audience in the US because clearly the Disney stock had tanked a good 4% in trade, what does Avatar 2 mean for PVR and Inox Leisure? We have our colleague Soumit joining us to tell us more.
Well, the much-awaited science fiction movie Avatar: The Way of Water has released on 16th of December, and so far it has netted close to 140 crore rupees in the first 4 days. Now, expectations were anyways high from this movie, given the fact that the prequel, that is Avatar, that released in 2009, was one of the highest grossing movie ever. Now, analysts are expecting the net collections from Avatar 2 to be close to around 300 crore rupees, and this is because channel checks are suggesting that the average ticket prices are trending higher than the average. Occupancies in premium format, that is especially the IMAX 3D, are trending upwards of 50% even during weekdays in metro cities like Mumbai, and except for Circus, which is set to hit the big screen on December 23rd, no big ticket release is lined up, giving Avatar a free run in the box office. Now, festivities are also expected to aid collections like Christmas and New Year, which is around the corner, and on the back of these factors, for PVR and Inox Leisure, the third quarter of FY23 or the ongoing quarter is expected to be much better on a sequential basis. Now, if you see in the second quarter, there were only 2 movies that surpassed the 100 crore barrier, and margin correlation of multiplexes with the number of movies crossing the 100 crore mark is very high. And as you can see in the first quarter of FY23, there were 6 movies that crossed the 100 crore mark, and the margins for PVR stood at close to 19%, and for that of Inox stood at close to 21%. And in the third quarter so far, 4 movies have crossed the 100 crore barrier mark, and that is Kantara, Drishyam and PS1 that have netted close to 220 to 300 crore rupees, and Avatar in the first 4 days has netted close to 140 crore rupees. Now, with 10 days to go for the quarter and no big ticket movie in pipeline, the performance for the Q3 for PVR and Inox completely hinges on collections that would come in from Avatar over the next 10 days.
Well, thanks so much for that, Soumit. We'll move on in an exclusive interaction with ET Now. Hero MotoCorp CFO and Chief Strategy Officer Niranjan Gupta reiterates that their long-term margin guidance of 14 to 16% remains intact. Stay tuned for the interview on ET Now. Here's a sneak peek.
Our long-term guidance still remains 14 to 16%, and I'll tell you why. And at 11%, which is the latest quarter, I think you are picking up. If you really look at the absolute gross profit per vehicle, it is at one of the highest levels in terms of rupees per vehicle. So I think that's another metric that you need to look at, that while percentages would have gone down because of the inflation and price rise, our absolute per vehicle hasn't been impacted that much. As we move forward, there are
So you mean like in telecom, we look at average revenue per user. For you, we should not be looking at margins, but this metric?
It's both. It's like if you're hurting on percentages, are you able to hold at least the absolute per vehicle? Okay. Because it's the volumes that sell and you multiply. Now that we've been able to hold, and that's been through a combination of our accelerated savings program, very judicious price increases that we have done in the market, a combination of all that factors. Moving forward, the factors that will help margins, and I'm not talking 1 quarter, 2 quarters, second half, I'm honestly talking more medium term, next couple of years, let's say. We would have the impact of now price increases moving ahead of inflation, because clearly there's been softening of crude, there's been softening of metals where aluminum, steel have come off from their highs. So we have that tailwind. Structurally, we are moving more towards premiumized products and premium. For instance, just to give example, we've launched X-Tech variants in each of the models spaces, Splendor X-Tech, Passion X-Tech, XYZ, Glamour X-Tech. Each of these X-Techs are at 5 to 7% premium compared to the base. And we expected only just 20% of sales to come through those variants. Actually, we are seeing 30, 40, 50% of sale coming through those variants. So even if our overall volumes would have held, through premiumization and through more premium launches we'll be doing in the next 2 years, we do see that our portfolio is structurally moving towards a higher margin platform. So I think a combination of the inflation cooling off and a combination of the portfolio structurally moving towards higher margin platforms, we do see coming back to this range of 14 to 16% in the medium term.
And moving on, Alphabet and Google chief Sundar Pichai said in an ET Now exclusive that India can be a shining example of what has accomplished with the unified payments interface, Aadhaar and India stack. Now, Pichai has also said that having responsible regulation which preserves some of the core elements is going to be absolutely critical. Now, he added that a free mobile operating system like Android has powered the digital revolution in countries like India. Now, he is a little concerned about some aspects of the CCI ruling against Google.
Well, yes, HDFC and Kotak, in fact, the HDFC twins and Kotak Bank have not seen a stellar outperformance in the past few years, but several tailwinds ensure that they remain long-term attractive stories. That's the word coming in from Adrian Lim of Aberdeen. Listen in to what his view on these banks and IT stocks are.
We have positions and we're investors in HDFC Bank, Kotak Mahindra. These are banking franchises, banking groups that we like a lot. We've known them over the years, and they've always been very clear about what they want to do, which is to provide financial services of the best quality for the market at a reasonable price, and be mindful of the risks that they have on and off their balance sheets as well. And be mindful for their investors to make sure that they have a reasonable risk return profile. The environment itself is more difficult to call. The credit growth is not as exciting as it could be, as it should be, but we think that would recover over the next 2-year time frame. But then valuations are not as demanding as they used to be. When you go back 3-4 years, when we were in a more exuberant part of the credit cycle. So I think it's a reasonable trade-off. But we continue to back the Indian banking sector, but it has to be on selective stocks. We don't buy
Adrian, the other pocket of fear this time around is IT. IT stocks are getting smashed like no before. Even though IT companies are doing a buyback, markets are disregarding them. At what juncture do you think the risk-reward ratio for an investor like you becomes favorable in investing in large cap IT?
We've had we still have a large position in some of the stocks there. I appreciate that the sector is going through a difficult time. But we still have quite a bit in Infosys and quite a bit in TCS as well.
Well, that was Adrian Lim for you on his outlook for 2023. Now, with that, we're completely out of time on this show, but you don't go anywhere. There's lots more action for you on the market on the other side.